Big moves are happening in the tech world as Qualcomm CEO Cristiano Amon makes high-stakes power moves in Korea. He has been spotted in back-to-back meetings with the leadership teams at Samsung Electronics, SK hynix, and LG Electronics to push the boundaries of semiconductor manufacturing and physical AI. This visit is setting the stage for major long-term partnerships that could redefine how your devices are built.
Your brand new iPhone deserves the best protection, and the iLune 3-pack screen protector plus 3-pack camera lens protector has you covered. Don't take risks with your iPhone. Click the link in the video description to shop now on Amazon.
Meanwhile, the stock market is buzzing as Qualcomm shares have just charged through a 9-day winning streak. Despite this impressive 11% rally, the broader picture remains a battleground for investors trying to determine if the bottom is finally in. With shares still down roughly 20% for the year, traders are locked in a fierce debate over whether this is a genuine recovery or just a temporary technical rebound. The core of the struggle for Qualcomm lies in the global memory chip crunch that is shaking up the entire semiconductor industry. As AI infrastructure expansion sends DRAM prices soaring, manufacturers are facing massive supply chain hurdles that directly impact the bottom line. With analysts at firms like JP Morgan and BNP Paribas expressing caution, the path forward remains anything but clear for the chip giant. Adding more fuel to the fire, UBS has just trimmed its price target on Qualcomm to $150, citing weakening fundamentals as the industry braces for continued memory price pressure. All eyes are now on the April 29th earnings report to see if these headwinds can be overcome. Want to stay ahead of the latest market shifts and tech news? Smash that subscribe button and ring the bell so you never miss an update. Ever wonder what happens when the king of mobile chips decides to go on a high-stakes road trip? Qualcomm CEO Cristiano Amon just wrapped up a whirlwind tour of Seoul, and let me tell you, this wasn't just a casual business lunch. It was a strategic power move that could redefine the future of your devices. Amon touched down in Korea for back-to-back summits with the absolute titans of the industry, Samsung, SK hynix, and LG. It's clear that Qualcomm isn't just looking to stay at the top of the mobile game. They're pivoting hard into physical AI and cutting-edge manufacturing. Think about it. Qualcomm provides the brains for our smartphones, but to scale, they need partners. First stop, Samsung Electronics. These two have been tight for 30 years, but this latest sit-down with the foundry leadership signals something much deeper. With global memory supply feeling tighter than ever, the talk was likely a high-stakes trade-off. Qualcomm secures the memory they need, while Samsung locks in the manufacturing of Qualcomm's next-gen 2-nanometer system chips. That 2nm process is the holy grail of efficiency, and seeing them hash out the details suggests we are on the verge of a major performance leap in our next upgrade cycle. But the trip didn't stop there. Amon also ducked into meetings with SK hynix and LG Electronics. While SK hynix plays a vital role in that supply chain, the move to court LG is particularly fascinating. They're moving beyond just appliances. We're talking about a future where physical AI and smart glasses become the new norm. It seems Qualcomm is betting that their future isn't just in your pocket, but in the very fabric of your smart home and wearable tech. So, what does this mean for us? It means the competition to build the smartest, fastest hardware on the planet just hit a new gear. If you found this deep dive into the chip war fascinating, hit that like button and subscribe for more tech insider breakdowns. After all, the devices of tomorrow are being built in these boardrooms today. Are you ready for the next evolution? Ever wonder if a 9-day winning streak is a sign of a massive turnaround or just a clever trap? Qualcomm is currently riding its longest hot streak since November 2023, climbing 11% in just under 2 weeks. But before you dive in, you need to zoom out. This stock is still nursing a 20% loss for 2026, and earlier this month, it hit levels we haven't seen in years. If you look at the first quarter, we saw a 25% crater, the worst performance for the company since 2002. Is this a real bottom, or just a technical blip in a deeper downward spiral? The massive elephant in the room is the global memory chip shortage. With the AI boom sucking up DRAM supply, the cost for manufacturers has skyrocketed by 500% since late August. This is a nightmare for Qualcomm. which lives and dies by the smartphone market. As stock strategist Ethan Feller points out, these supply constraints are a genuine near-term brick wall, making the growth trajectory for the next year look incredibly steep. The sentiment on Wall Street is equally cold. With at least 8 downgrades this year and the weakest analyst consensus in 16 years, Qualcomm is looking lonely compared to the rocket ship success of peers like Nvidia or Broadcom. Even JP Morgan and BNP Paribas recently pulled back, warning that memory costs will remain a major headwind well into next year. Analysts are projecting earnings to drop nearly 10% this quarter, and Zacks has slapped the stock with a strong sell rating. CEO Cristiano Amon is trying to pivot the company toward automotive and data centers to break free from the smartphone dependency, especially as Apple slowly drifts away from Qualcomm modems. But these new ventures just aren't scaling fast enough to plug the holes in the ship. Trading at 12 times forward earnings, the stock looks cheap compared to the sector average. But is it a value play or a value trap? Some, like Steve Bruce of Bruce Wood Capital, think the company is executing well despite the chaos, but all eyes are now on the April 29th earnings report. After a brutal 8.5% drop following their last forecast, the pressure is on. What do you think? Is this the bargain of the decade or a sinking ship? Drop a comment below, and don't forget to subscribe for more deep dives into the tech market. Ever felt like you were watching a comeback story, only to realize you were just looking at a minor blip on a much larger downward slide? That's exactly the questions swirling around Qualcomm right now. The stock has been on a tear lately, riding a 9-day winning streak that's pushed it up about 11%. It's the kind of momentum that gets traders excited, but if you zoom out, the reality check is brutal. Even with this recent bounce, the stock is still sitting down 20% for 2026, and earlier this month, it hit levels we haven't seen since 2023. When you consider that Q1 of this year was Qualcomm's worst quarter since 2002, this recent rally feels less like a triumphant return and more like a brief moment of oxygen for a stock that's been struggling to breathe. So, what's actually breaking? It comes down to one word: memory. The AI gold rush is demanding massive amounts of DRAM for data centers, and it's creating a supply crunch that is devastating for consumer electronics. Since late August, the spot price for DRAM has spiked nearly 500%. That is a massive, unavoidable tax on Qualcomm's business model, which is still heavily tethered to smartphone manufacturers. As stock strategist Ethan Feller points out, the growth outlook for the next year or two just isn't looking good. And Wall Street agrees. We've seen at least 8 downgrades this year, and for the first time since 2008, the analyst consensus is looking shaky. When you compare Qualcomm to tech heavyweights like Nvidia or Broadcom, who are still boasting buy ratings from over 90% of analysts, it's clear that sentiment has soured. Even JP Morgan and BNP Paribas are staying cautious, noting that this memory price squeeze isn't going away anytime soon. We are looking at earnings estimates that are being slashed, with revenue expected to contract for the fiscal year. Meanwhile, CEO Cristiano Amon is trying to pivot the company toward autos, PCs, and data centers to break free from the smartphone dependency, especially as Apple continues to move away from Qualcomm's modems. But the truth is, those new markets just aren't big enough yet to plug the hole. The stock is currently trading at 12 times earnings, which is a discount compared to its 10-year average and significantly cheaper than the wider semiconductor sector. Some value investors might see that as an entry point, but others see a classic value trap. With Q2 earnings looming on April 29th, the pressure is on. Can Qualcomm finally deliver a surprise, or are we in for another February-style sell-off? The market is skeptical, and for good reason. If you want to navigate these volatile waters, you need the right data. We've just released our top stock picks for April, focusing on companies with serious momentum that have passed our strict KO score algorithm. Whether you're a long-term investor or hunting for short-term gains, we've got you covered. Sign up for Knockout Stocks today and use the coupon code SPECIAL50 for 50% off to see the full list of our latest high conviction ideas. Ultimately, the market is a brutal teacher. It doesn't care about your entry price, only the future. Is Qualcomm a deep value play or a ship taking on too much water? That is the billion-dollar question. Is Qualcomm heading for a rough patch, or is this just a temporary speed bump for a tech titan? UBS just dropped a bombshell, cutting Qualcomm's price target from $160 down to $150, and investors are feeling the heat. With the stock already down 20% year-to-date, this isn't exactly the news shareholders were hoping for. But why the negativity? It boils down to a classic case of rising costs hitting the bottom line. As memory prices climb, smartphone manufacturers are feeling the squeeze, which naturally cools off demand for the chips Qualcomm supplies. It is a domino effect that is hurting one of the biggest names in the industry. UBS is essentially telling us that the reset we were promised hasn't quite taken hold, and the fundamentals are looking a bit softer than we'd like to see. While Qualcomm is making some impressive strides in diversifying their business, like that solid 15% growth in the automotive sector, the reality is they are still heavily tethered to the handset market. And until that memory supply constraint eases up, that reliance is a major vulnerability. We are seeing the analyst consensus drift down toward that $150 mark, signaling that the street is getting significantly more cautious. Sure, a forward PE ratio of 12 might look like a bargain on paper, but as the old saying goes, a cheap stock can always get cheaper if the earnings estimates keep sliding. Still, it's not all doom and gloom. If you are a long-term believer, Qualcomm is still putting up some serious numbers, and that dividend, paired with a massive buyback program, gives you a nice cushion while you wait for the storm to pass. So, what should you do? Keep your eyes glued to those Q2 results. If we start to see that handset segment stabilize, we might be looking at a great entry point. If the pressure continues, we could be in for a longer grind. What is your take? Are you buying the dip or waiting for clearer skies? Let me know in the comments below, and don't forget to hit that subscribe button for more deep dives into the stocks moving the market. After all, the best time to do your homework is before the market opens tomorrow.